Today we are joined by Mr. Jacob Mitchell, the Chief Investment Officer and founder of Antipodes. Jacob, as the founder of the company, can you tell us a little bit about your background and the history of the company?
We founded Antipodes in March 2015 as a high conviction manager of global and Asian equities, both long only and long short. We clearly have a focus on capital preservation. Previously, I worked for 14 years at Platinum Asset Management, most recently the Deputy CIO, responsible for just over $3.5 billion of FUM in a direct management sense. And it was for me, Antipodes is just simply the next step in a record of high conviction investing. We've built out a team. Across the team, we have over 100 years of experience in global equities investing. And we are also partnering with Pinnacle, primarily as the provider of our infrastructure and our distribution support. And that allows the investment team to really focus on investing. And where we launched our funds in 1 July 2015 and we're very sort of enthusiastic in terms of how we manage the business, and we see the benefits of creating a structure of very tight alignment between investors and the investment team.
How is your investment team aligned with investors?
We've decided to offer products with performance fees to put a fair amount of the firm's compensation at risk, in the sense that if the investment team doesn't produce performance, then ultimately there will be a fairly small bonus pool. If the investment team is successful, and we look at this over the medium to long term, so 3 to 5 years, then there is that great outcome for investors and the investment team, and I think that's the best way of creating a simple, transparent alignment.
What are the investment objectives of the fund, and what is your investable universe?
So the objective is to deliver absolute returns ahead of the benchmark over 3 to 5 years at no greater risk than the benchmark. In this case, the benchmark is the MSCI Asia ex-Japan index, and we also have the flexibility in the mandate to invest up to 30% net exposure in Japan, but we don't want Japan to overburden the fund, given that the real exposure we're seeking longer term is to the emerging Asian middle class, which is a story around those two very large economies, China and India. We see benefits, though, to have the flexibility to gain exposure to a maximum net 15% to non-Asian emerging markets and Oceania, simply because a lot of the trends that are impacting those emerging markets are very similar to what's happening in Asia.
Can you talk through the investment philosophy behind your strategy?
We see investment returns as a function of the business, the quality, the resilience of the business you're buying. And that is ultimately measured by the sustainability of its competitive advantage. And then it's a function of what you pay for that business. So that is our definition of return. Our definition of risk is a combination of stock level risk. So we control that by buying businesses cheaply. Margin of safety protects you from that permanent loss of capital, which is what real stock level risk is all about. But it's more than just resilient businesses, it's resilient investments. And that's the concept of multiple ways of winning. So your investment case cannot be dependent on just one single factor outcome. The second aspect of risk is going beyond stocks. It is the behaviour of the overall portfolio. So when we're looking for opportunities, as a high conviction manager, we're only looking for 30 to 50 stocks in a universe of 4,000 companies. That means we can be very selective and we can build portfolios with non-correlated sources of alpha. So the next question is, why should you be able to buy those selective stocks at a discount to intrinsic value? And we think that happens because markets can tend to be irrational around changes in the environment that are impacting businesses. Those changes that we see typically fall into three buckets. They're either cyclical, structural, or they're broad macroeconomic changes. It's when markets become irrational that you get the opportunity to buy the company, a great business, at a great price.
Your investment approach talks about the market's tendency for irrational extrapolation. What does this actually mean for investors?
The concept of resilience or sustainable competitive advantage must be subjected to ongoing tests, because the problem with really resilient businesses that are highly profitable is they attract competition. And in a cyclical framework, that typically means capacity or new competition leading to capacity expansion in an industry, and then when there's a small change in demand, that's enough to tip the industry into the shakeout phase. In a structural sense, it is a strong incumbent that becomes quite lazy, starts to feed off its profit pool, profiteer, and opens up a price umbrella for new competition. In both situations, it's really about challenges that are facing the business, whether they are technological or competitive or regulatory or simply management missteps. And that is what typically allows us, and only with a disciplined fundamental approach can you determine whether the impacts are permanent or temporary. But it's that's what we describe as irrational extrapolation around those factors that opens up an opportunity to buy a business, a great business at a great price. That's what we mean by irrational extrapolation. And we bucket that as cyclical, structural, and socio-macroeconomic. And it's ultimately a continuum. All three factors impact businesses at all points in time.
In terms of process, how do you select stocks for the portfolio?
Best way to describe it is an eclectic approach. It's a combination of the qualitative experience of the team and pretty heavy use of quantitative tools. In our experience, the combination of both is very powerful. We also manage the team as a scarce resource. We're ultimately a performance-based research organisation. So before we go too deep into a project, we like to use the quant experience is very good for getting a broad perspective before we go too deep. And also we use a buddy system whereby each lead analyst on a project also has a buddy assigned. And the role of the buddy and the role of the investment team before we go too deep is to act as a sounding board for the promoter of the idea to provide a reality check. And the reality check is around a common sense test of the likelihood of a margin of safety, multiple ways of winning, and the likely diversified nature of the alpha outcome relative to what we already own. So the existing portfolio informs the investment process. We won't research ideas that we already believe we are fully exposed to within the portfolio. We can be selective, we can work on something that does have a non-correlated alpha profile.
Please describe how you integrate your considerations of environmental, social and governance issues in your investment process.
Consideration of environment, social and governance factors is done as a part of the deep dive research process. We see it as ultimately a way that we measure the performance of management. And in our investments, we're looking for a minimum acceptable level of performance. And then ultimately, to the extent that companies that we have invested in do start to fail in this area, on a case-by-case assessment, we may choose to actually divest the company. So it is seen as an important part of controlling risk around management behaviour, is simply the study of the track record. The track record is the best indicator of future performance by management in this area.
You manage a concentrated portfolio. How do you manage this risk?
So we manage concentration risk through two principles: minimum level of diversification, and secondly, diversified sources of alpha. So what does that mean? For us, the minimum level of diversification is 30 to 50 stocks. Why? Because beyond 30 stocks, you get most of the random benefits of diversification from a protection from unknown risks, the risks that you can't control. That gives you most of those benefits. Diversified sources of alpha is a little bit more of a qualitative assessment of risk, where we believe we can control and measure build-ups of similarity in the portfolio, and making sure that the portfolio will behave in a way where if there is a shock, maybe it's a certain outcome, tail risk event, we know where the concentrations of risk are, and we have diversified our alpha source sufficiently to protect against those sorts of outcomes.
Your strategy can have a broad asset allocation across different regions. How do you manage currency risk within the portfolio?
So we see currency as another risk that we need to manage. So when we buy a stock, we also buy a currency. As a part of our consideration of socio-macroeconomic factors, we consider that currency risk. And if based on our fundamental valuation models of currencies, if we believe the currency is significantly overvalued, and we do apply a higher margin of safety in that assessment because of the unknown risk around anything that is macro in its assessment, we will hedge out of that currency into a currency that we feel is more attractive as an evaluation sense. That is ultimately a strategic view, and so our currency views a very high conviction in that sense.
Your strategy can use short selling. How do you determine when you use short selling within the portfolio?
We short sell for three reasons. Ultimately, drive alpha. Sometimes we also get the opportunity to hedge a specific risk on the long side. And also there are times when we want to protect the portfolio from tail risk. In terms of how we execute in stocks, we're looking for companies in a cyclical sense that are really on the tipping point from the exuberance to the shakeout phase. And then in a structural sense, it is looking for those incumbents that may have lost focus and hence have opened up a window for an incumbent to disrupt their business. And then very common today, you often see markets become very enthusiastic around the disruptors and irrational extrapolation kicks in. But when you actually assess the underlying business model, what you have is an investment theme, not a resilient investment. And a small change in the environment can see those companies come under real operational strain. That's also another source of short opportunity. So cyclical, incumbents that are being disrupted, and then disruptors that are actually just weak businesses. Three opportunities for us to short.
How does using tools like short selling and derivatives help the portfolio to manage risk?
Well, when we short sell, either in single stock or in a index, we are reducing our net exposure to markets. In the case of currencies, we use typically forwards to reduce our net exposure to expensive currencies. So both of those combined have great risk management characteristics.
In terms of exposure, what is your typical net invested position within your Asian strategy?
So the typical net investment position to equities is 50 to 100%. Because it is a long-short fund, it also has a gross limit of 150%, which means the addition of our gross long and our gross short can't be greater than 150%. In addition to those conditions, there is an exposure limit to Japan of net 30% and an exposure limit to Oceania and emerging markets of net 15%.
Within your Asian strategy, what sort of investor does the fund suit, and what is the recommended timeframe for investment?
The fund suits an investor who's looking for exposure to Asian equities in a high conviction capital preservation approach with an investment time horizon of 3 to 5 years. The fund has the added benefits of being able to short and manage currency, and there is also the more general benefit of simply gaining exposure to industries that are not represented in the Australian stock market, and the broader benefit of diversification away from Australian assets.